Hey everyone, welcome to Mortgage Breakdown. If mortgages feel confusing, don't worry. I'm here to make them simple. Today, we are starting out with the basics, what a mortgage actually is and why it matters if you're buying a home. So what exactly is a mortgage? At its core, it's just a loan you take out to buy a home. Since you probably don't have hundreds of thousands of dollars in cash lying around, the bank lends you the money. You pay it back each month with interest, usually over 15 to 30 years. Let's run some numbers. Say you're buying a $300,000 home. If you put down 20% or $60,000, your loan amount would be $240,000. On a 30-year fixed mortgage at 6% interest, your monthly payment is around $1,440. But here's the kicker. What if rates go up by just 1%? At 7% interest, that same loan jumps to about $1,600 a month. That's nearly $2,000 more every year. And remember, this doesn't even include taxes and insurance. Now let's flip these numbers. What if instead of buying a $300,000 home, you bought one for $500,000 with that same 20% down? Your loan amount would jump to $400,000, and at 6% interest, your monthly payment would be around $2,400. This shows how both the price of the home and the interest rate work together to affect affordability. Now, what if you don't have $60,000 saved up? Can you still buy a house? Yes. That's where FHA, USDA, and other loan programs come into play. Some loans allow you to put down as little as 0 to 3.5%. For example, with FHA, on that same $300,000 home, your down payment could be just $10,500 instead of $60,000. But here's the trade-off. Your monthly payment will be higher, and you'll also pay PMI or private mortgage insurance, which we'll get to in a moment. Here's something a lot of people miss. Your monthly payment isn't just principal and interest. It actually has 4 parts: principal, interest, taxes, and insurance. The principal is the actual amount you borrow, the price of your home minus your down payment. Interest is what the bank charges you for lending you that money. Here's the part most first-time buyers don't realize. In the early years of a 30-year loan, the majority of your payment is going toward interest, not principal. That's because of how amortization works. The loan is structured so interest is front-loaded. For example, if your monthly payment is $1,400, only about $300 of that might actually reduce your loan balance in the first month. The other $1,100 is interest paid to the bank. Over time, the balance shifts. More of your payment goes to principal, less to interest. But in the beginning, that's why interest rates make such a huge difference. A higher rate doesn't just raise your payment today, it slows down how quickly you build equity in your home. Now let's say you decide to pay an extra $100 toward principal every month. Over time, that could cut years off your loan and save you tens of thousands of dollars. Taxes are the property taxes your lender collects and pays directly to your county. Keep in mind, those can change. If your county reassesses your home at a higher value, your monthly payment can go up even if your loan terms stay the same. And finally, insurance. That includes homeowners insurance, which protects your property and liability, and sometimes PMI, which protects the lender if you default. Though insurance seems pretty straightforward, here's something to consider. What if your insurance premiums increase over time? That can happen if you make a claim for storm damage or if rebuilding costs in your area go up. Even though your mortgage payment may feel stable now, things like insurance and property taxes can cause it to rise. So it's important to budget with a cushion. So, mortgages have both benefits and drawbacks. The obvious benefit: you don't have to save the full cost of a house. You can buy now and you'll build equity over time. The drawback: interest. Over the life of a 30-year loan, you might actually pay more in interest than in principal. That $300,000 house could easily end up costing you $600,000 or more once everything is said and done. And if you can't make payments, you risk foreclosure. Let's talk about PMI, private mortgage insurance. This is required if your down payment is less than 20%, and it can add $150 to $300 or more to your monthly payment. The good news, it doesn't last forever. Once you build up 20% equity, either through payments or if your home value goes up, you can usually request to have PMI removed. That could save you hundreds every month. So here are the key takeaways. A mortgage is simply a loan to buy a home. Every payment includes principal, interest, taxes, and insurance. And understanding your loan options could save or cost you thousands. One last tip, what if you plan to move in just a few years? In that case, the details of your loan, like whether PMI lasts for the life of the loan, may not matter as much as keeping your upfront costs lower. Thinking about how long you'll keep the home can completely change which mortgage makes the most sense. If you found this helpful, go ahead and subscribe. In the next video, I will break down FHA versus conventional loans and help you figure out which is the right one for you. See you there.